Hello and welcome. In this video, we will learn what swap and forward contracts are. Alright? In the previous video, we learned what a derivative is and we learned the types of derivatives. Derivatives are of mainly four types: futures, forwards, options, and swaps. In this video, we will learn in brief about forward and swaps. Okay? This topic will be limited to only this video, as this video series is about futures. About options, I have created a separate playlist in which I have taught about options trading in detail. Okay? So let us start learning about forwards and swaps. Starting with swap. Okay? Now to explain you the concept of swap, I have taken an example. There are two companies. One is A and one is B. A is a good company, B is a bad company. Now what do I mean by good and bad? By good, I mean its business is running good, its credit ratings are good, and it has a good reputation. Okay? And by bad, I mean the opposite of good. The business is not running good, it has a bad reputation, and it has a bad credit rating. Okay? Now, if this company wants to buy something or if it wants to expand, then it has to ask for funds. Correct? And let us say when it asks for loan, it can get loan of any money at 5% interest and which is fixed. Okay? So if this company wants loan, then there are institutions or banks willing to give loan at 5% fixed interest rate. Okay? And let us say they take a loan of 1000 rupees. Now I've kept this very small. Okay? I do not want to complicate things by taking a very large number. So I'm taking this. Okay? So let us say that this company wants to take a loan of 1000 rupees. Alright? Now, B is a bad company and so many banks are not willing to give out loan to them. Okay? Some banks are willing, but they charge 6% interest and it is a variable interest rate, meaning this can change anytime. Alright? And this company also gets, or let us say takes a loan of 1000 rupees. So this company and this company both take 1000 rupees loan, and this company should pay 5% fixed interest rate and this company should pay 6% variable interest rate. Now what these two companies do is they swap their interest rates. Okay? They swap their interest rates or they enter into a swap contract. Alright? Now due to this, what happens is company A will be paying 6% variable interest and company B will be paying 5% fixed interest rate. On what? On the loan amount that they take. Okay? Now how does this benefit B? Initially, it had to pay 6% interest rate and it was variable, meaning next year it may increase to 7%. We do not know. Okay? But now, since it has entered into a swap contract, it just needs to pay 5% fixed interest rate. So by using this lesser interest rate, they can build their reputation, and from bad they can try to become a good company. Okay. Now, how does this swap contract benefit this company, which is good? It benefits this company only when the 6% becomes less than 5. Okay. See, it is 6% variable now. What do you mean by variable? Variable means it can change. Alright. This is fixed. This is variable. So, after a year, if this 6% becomes 4%, then it will be a benefit to this company. Okay. So this is how it will benefit from the swap contract. Alright. This is all you need to know about a swap contract. Alright. There are much more details about this which is out of scope of this video series. So if you are interested to learn, you can go to Google and search for them and learn by yourself. Okay. Now, these swap contracts are not traded on stock exchange. Okay. An investment banker plays the role of a middleman between these contracts and does the job. Okay. And there are many types of swaps. An interest rate swap, commodity swap, total returns swap, debt equity swap, credit default swap, currency swap, etc. Okay. The most common kind of swap is an interest rate swap, which I just explained now. Alright. Swaps, as I mentioned, do not trade on exchanges, and retail investors, meaning people like you and me, do not generally engage in swaps. Okay. These are over the counter contracts, and these happens primarily between businesses or financial institutions that are customized to the needs of both parties. Okay. So just know that this is how it works, and apart from this, it is by your interest you need to learn about a swap contract. Okay. Next, moving on to a forward contract. Okay. Once again, I am going to take an example to explain you the forward contract. Let us say there is a farmer who grows tomatoes. Okay. So there is a farmer who grows tomatoes. Now this farmer has sown seeds of tomatoes in January. Okay. He has sown seeds in January. And he is expecting 1000 rupees worth of tomatoes at the end of May. Okay. So from January till May, the tomatoes grow, or the plant grows, and by the end of May, he is expecting that the yield will be rupees 1000 worth. Okay. Now, this is fine. But then he has some doubts, or he gets some doubts in his mind. That is about these. What will happen if the plants that he grows catches a disease? And what if by the end of May nothing survives, or only some of the tomatoes survive? What if the price of the tomatoes fall by the end of May? He is expecting to have 1000 rupees worth of tomatoes, but what if the price falls and it is very less than this? What if there is a drought? Drought meaning less water. Okay, less water. The monsoon fails and there is drought, and so the crop fails too. Or what if there is a flood due to which the crop that he grows gets damaged? So he has these doubts in his mind. Okay? So we'll stop this story here and continue it later. Now, there is a factory or a company which manufactures tomato ketchup. Okay? Now let us look at the perspective of this company. This company or factory thinks that the tomatoes that the farmer grows will be worth more than 1000 rupees. Which farmer? The farmer that I just explained you about. Okay? So this is what this company thinks. Okay? Tomatoes that the farmer grows will be worth more than 1000 rupees. And in the worst case, okay, in the worst case, it will be worth 700 rupees. Okay? They are expecting it to be worth 1000 rupees, but due to unforeseen circumstances, it will still be worth 700 rupees. Okay? This is what they think. This is what the factory thinks. And so, the farmer and the factory get into a forward contract. Okay, get into a forward contract in which the factory offers to buy the entire harvest at rupees 700 in May. Okay, so in January he has sown the seed, in May he will be harvesting it, and this factory offers to buy the entire harvest at 700 rupees. And the farmer agrees to sell his entire harvest at 700 rupees in May. Okay? So farmer expects it to be worth 1000 rupees, but then he also has doubts of disease, falling prey, droughts and floods. So he is not willing to take a risk, and so he agrees to sell his entire harvest at 700 rupees in May. So they come into a contract, and this is called as a forward contract. Okay. Now in May, there are three things that can happen. One is the worth of tomatoes is 700 rupees. Okay. In May, when the farmer harvests, the worth of tomatoes is 700 rupees. So no one gains here. Okay, no one gains here. Alright? Because they entered into a contract of buying and selling at 700 rupees. So no one gains here. Next, the second case is the worth of tomatoes is rupees 500. Okay? So some problem has occurred, maybe the prices have fallen, and so the worth of tomatoes is 500 rupees. So now the farmer gains because the factory has entered into a contract to pay 700 rupees to the farmer, correct? And buy everything that he has got. He has grown tomatoes and it is worth only 500 now. But according to the contract, he will be getting 700 rupees. So here the farmer gains. The third case is the worth of tomatoes is rupees 1200, and so the factory gains in this case because they have entered into a contract saying that factory will purchase at 700 rupees. So they only need to pay 700 rupees to get this much worth of tomatoes, and so the factory gains in this case. Okay, so these are the three possibilities that can happen in May. Now there are risks too. What are the risks? The worth of tomatoes is rupees 500. Let us say that the worth of tomatoes in May is rupees 500. But the factory doesn't buy them. Okay, factory refuses to buy them. So the factory says, I am not willing to pay 700 rupees because they are worth only 500. So I am not going to buy them. So what happens to the farmer? Where should he go? Correct? So this is a risk here. Or the worth of tomatoes is 1200. And so the farmer asks more money with the factory. So the farmer says, okay, so the worth is 1200. I am not willing to sell at 700. So I want more money. Okay. So this is what the farmer can say. Once again, this is a risk. Next, the farmer or the company can back out from the contract just before harvest. Alright. Now let us say it is time for harvest and the farmer thinks that everything has gone fine and so he will get 1000 rupees worth of tomatoes. So just before harvest, he will back out from the contract. So he will say, no, I do not want to enter this contract wherein you are buying at 700 because I know it is worth 1000 now. So I am backing out of this contract. So the farmer can say, or in the opposite condition where the harvest, where the factory thinks that they will not be getting 700 rupees worth of tomatoes, they can back out from the contract too. They can say that, okay, according to what we are seeing now, we will get less than 700 rupees worth of tomatoes and so we do not want to enter the contract. Okay. So that is a risk here. There is no guarantee here. So these are the risks associated with the forward contract. Okay. So remember that it is just a contract and no money has been paid by anyone. Alright. It is just a contract. So these risks are what are the disadvantages of forward contracts are. And all these are eliminated in futures contract. Okay. Now these forward contracts, when traded on a stock exchange are called as future contract. Okay, futures contract. Or futures contract which are not traded on a stock exchange are called as forward contracts. Okay. These contracts are not traded. These forward contracts are not traded on stock exchange. This happens between a buyer and a seller. Okay, over the counter. So this is almost obsolete now and everyone goes for a future contract. Okay. So that is all that you need to know about forwards contract. Alright. So I hope you have understood what a swap and what a forward contract is. From the next video, we'll start learning about futures contract in detail. Alright. So I'll see you in the next video. Till then, take care and thank you for watching.